How's it going, everybody? My name is Antonio, and you're about to watch or listen to a conversation that is general and impersonal in nature, one that is likely to discuss very high-risk speculations and will include no financial nor investment advice whatsoever. There is a full disclaimer on your screen right now, and I suggest, unless you like losing money, you pause the screen and read that full disclaimer. While you're at it, let me just introduce my guest here shortly. He is a man of many resource talks. And rumor has it, he once rode a bear while on a mine visit in the jungle of Congo, after which he ended up making 100x on that investment and gave it all to charity. But there's so many rumors out there, and I don't know if this one's true. But ladies and gentlemen, Rick Roll, thank you for being here.
Pleasure, Antonio. I wish I'd heard that rumor.
Well, some rumors out there you maybe don't want to hear, but all of them are very pleasant, at least for entertainment value. Pleasure is all mine, of course, and maybe if I see you during, let's say, a conference in Florida, for example, this summer, I might try and get you drunk and ask more details about riding bears in jungles. But so today, I actually want to talk about something that is even higher risk than that, which is uranium stocks. And last time we spoke was roughly 4 months ago, and you told me that prior to that conversation, you thought that the uranium stocks had gotten out of sort of ahead of themselves, actually, is what you said, but that they were coming to a more acceptable valuations. At the time of the recording is what you told me. That must have been August. And since then, unfortunately, uranium stocks have kept falling. So just to kick it off, what do you think is going on with the uranium market? And are you surprised that it stayed suppressed for that long?
I'm not. I think the expectations around uranium got ahead of themselves. And I think that they evolved a speculative community that became involved in the stocks for more narrative purposes than any other purposes. When I look across the length and breadth of the uranium sector, I see about 70 juniors worldwide. And I think of those 70 juniors, probably 15 are viable. So that sort of tells me that for well over 50 names in the sector, they have no net present value, but they have market capitalizations, which suggests to me that the junior sector, taken in its entirety, is still ahead of itself. But the skills around securities analysis aren't well distributed among uranium speculators. And I would suggest to you that the best 10 or 15 names in the space are reasonably priced, if not cheap. When I say reasonably priced, I use an assumption of $60 a pound versus $50 a pound, which is the current price. I use what I call a market clearing price. And at the $60 price level, many companies are reasonably priced. If you believe, like I believe, that the uranium price will go not merely to the total cost of production, including working capital, but rather to the incentive price, the price that would be required to build new mines, which is $75 or $80 a pound. Then across the landscape, looking out 2 or 3 years, the uranium stocks go from reasonably priced to being cheap. Some of your listeners are not going to want to take that whole range of risks that involve making pricing assumptions 2 or 3 years out. The market itself demanded immediate gratification, which is why the market sank of its own volition. People bought uranium stocks at 75 cents, and they had so little confidence in the uranium stocks that when the stocks fell to 60 cents, as opposed to going up, people lost faith and patience because they hadn't been rewarded in the 90-day time frame. So the discussion that we're going to have necessarily involves investors who are more attracted to arithmetic than to narrative, people who are willing to stomach both risk and volatility, which are very different things, and people who have a 2 or 3 year time frame, which is the time frame that I believe is required to make good, reasonable money on speculation.
There's 2 points that I want to talk to there, because that is generally sort of the consensus that I've seen out there whenever I would review a company and I would say, hey, why is it trading at this valuation? And people would say, well, because the market is valuing it at the current spot price, not at what the price is going to be. The price is going above $100. which makes me think about risk reward, and it makes me ask myself, why do I want to go into something that, like, I don't even know if the company is going to be around then, but if I think that uranium is going to double, why wouldn't I just want to buy something like the Sprott Physical Uranium Trust, which is lower risk, in my opinion.
I think for many of your listeners, that's superb advice. People are often attracted to my interviews because they've read stories about the amount of money I made in the original uranium boom. Mm-hmm. They love the Paladin story, the sort of 10,000 to 1. There is a class of speculator out there who is really interested in taking risk to change his or her lifestyle. For most people, the people who aren't willing to do the work and the people who can't afford, either psychologically or financially, the risk associated with quantum reward, those people need to focus on market beta. And my suggestion is that there is enough reward in the uranium sector doing precisely what you suggested, buying the Sprott Physical Uranium Trust, perhaps buying Cameco, perhaps for 10% of your money, buying the waterfront through the ETF. I, of course, would prefer the Sprott ETF for obvious reasons. I think that there is enough upside and enough probability of an increase in the uranium price that capturing the market beta, I'm defining beta as the difference in price performance between the uranium sector and the general equities market, that many investors would be well advised, rather than becoming really, really aggressive risk takers, simply to involve themselves in the probability that the uranium price goes higher, and that the lowest risk uranium alternatives, investment alternatives, give a very good juxtaposition of risk to reward for beta dollars.
I think this is especially valuable right now when a lot of the juniors are struggling for capital, and sometimes you literally don't know which ones will make it through without diluting you out of the stratosphere or not. So I think that's especially valuable there. And go ahead. You want to say something?
Well, I was going to say, as a speculator, and we've talked about this in prior interviews, a lot of management teams in the mining business generally, but in the uranium business particularly, played chicken with capital markets, which is to say they didn't raise money last summer when they could, because they thought that the share prices could go up and they could raise more money with less dilution. In virtually every case where companies did that, they lost the bet. And now you have a whole range of junior exploration companies, including junior uranium companies, that are going to have to come to market. And they're going to have to come to market in conditions where the market is less optimal. In probably 50 or 55% of their names, I regard them as unviable. So there is virtually no price at which I'd like to participate. But in 12 to 15 names, well, that's not true. In more like 10 names, there are companies that will likely need to raise money in the last 12 months. And if they're forced by market conditions to do it on terms and conditions that are more favorable to me than they are to their existing shareholders, I look forward to participating. Then, of course, you have that very small range of companies that have very good upside associated with them, but are also adequately capitalized, have enough money in place that they get through the next 2 or 3 years without having to return to the well. Those can be good aftermarket investments, but you won't be able to participate in private placements in those companies. You won't be able to get warrants simply because they were prudent.
Who do I have to kill to get my hands on that list of the 10 companies?
Well, I would prefer that you didn't kill me, but you might ask me. As you know, I have a private placement list in my own database where every private placement that I participate in, I distribute information on for free to my database. That doesn't mean that I will be included in every viable uranium private placement, because I'm pretty picky as to prices and terms. It also doesn't mean that if I get included in the private placement, that people who read my notice will be able to be included. Private placements on good terms often sell out fairly quickly. And the companies themselves often focus on what they consider to be value-added investors. And I do my very best personally to be a value-added investor. But I think that we will have opportunities in the next 12 months for companies that I think are viable speculative opportunities to participate in private placements in circumstances where they need capital and where the capital isn't necessarily forthcoming from the market on generous terms.
I do want to talk about private placements a little bit later on in the video. For people who, for the 90% of people who are going to drop off by then, though, what was that email address that they send an email to get on that list?
Well, you go to ruleinvestmentmedia.com and you will see a button. I think it says rank your portfolio. So the first thing to say is I will certainly rank people's portfolios, including their uranium portfolios, for free. But in the question and comment section there, if you care about my private placement database, and if you are accredited, which is to say you can afford the risk in private placements, simply say placement, and I'll put you on the database. I'll put you on the notification database. I should say, too, don't expect a notification a week, because although I'm actively trying to deploy money in private placements, there's often a very wide gap between the bid and the ask, which is to say the price at which I'm willing to provide placement capital and the price at which the company is willing to accept it. There can be easily 3 months that go by when I will make offers on 50 private placements and perhaps be able to complete one.
Well, that actually tells you maybe a lot about the industry that you have to know. This also might be one of the sickness of the industries too, but I would sometimes talk to the management and they would be like, I wish I'd raised money at higher prices. And I'm like, well, a smart man once taught me that you should do what's easiest. So if it was easy for you to raise money, isn't it your fault that you didn't raise money? I mean, is that not a lesson that a CEO should know? And oftentimes they're like, well, we do have a good project, and they would change the topic. So that's always, I'm
Right.
reminded of your interviews at that point. I made this a topic of a whole interview, by the way, something that I've been thinking about. I interviewed a uranium geologist, and he didn't really know the definitive answer as to why that is. But what I've noticed is that some of the explorers, specifically in the uranium space, will make a discovery that shows, let's say, 1% of uranium, which is maybe in uranium, specifically, like if it's Athabasca, people are like, oh, that's low grade, but it's still $1,000 rock in terms of value, give or take. But so they would make that discovery, or they would drill that kind of hole, and their stock wouldn't move, like the market wouldn't care. Now, if that happened to a gold company, let's say if a gold company drilled $1,000, what's that? The equivalent of 20 grams of gold over 50 meters. Their stock would explode if it's like a 20, 30, or 40, $50 million company. So do you think there is maybe a value discrepancy between the explorers in the uranium space specifically, explorers that have made a discovery already, and the explorers in different sectors?
It's important to rather than merely focus on grade, focus on tonnage and grade. One of the things that happens in the Athabasca Basin is that you can get some very high-grade accumulations on the unconformity, that place between basement rock and the sediments. You can get some extraordinarily high grade, but the enclosed tonnage is so small that you can't afford the capital expense to go get it. So you can have $1,000 rock, but it ends up that the amortization of the capital that would be required to get it would require $2,500 rock. So although the headline press release is attractive, if you do a little bit of work to try and determine back of the envelope what the probability is that discovery becomes economic, then the laggard nature of the stock response comes much more clearly into focus. There are certainly circumstances where rock that's 0.25% is substantially more valuable than rock that's at 5%, because the 0.25% rock is on surface, has good metallurgy, and has tens of millions of tons, where the 5% rock may be 600 meters down and in fairly small quantities, so that the upfront capital cost required to produce it would render the deposit uneconomic. The devil is often in the details.
How I've been taught to do this would be, and you tell me if that's right or wrong, or how you do it, I would appreciate that, is to calculate the volume. It could be a cube or a tube. So you would calculate the volume, and then you would multiply it by the grade. and you would multiply it by the density factor of by the density of the rocks. I mean, it oftentimes 2.8, 2.6, 2.9, something along those lines, depending on the different rock, but that doesn't make too much of a difference, I guess. And then you would apply a discount factor to it for just to see how much of it you think is appropriate in that situation. Is that how you would do it? Is that sort of the formula that you would use?
That's the first step.
Okay.
And then you may need some help for this. You have to estimate what the capital expense would be to access the deposit. And then you have to have a discount mechanism that involves the time value of money. If you believe that the deposit's going to be extracted this cycle, which is to say the next 5 to 7 years, you would have a higher expected net present value than if you have a deposit that will require another 3 or 4 years of exploration and likely not be developed for 10 or 15 years. On a time value of money basis, even assuming an investment grade credit, which is to say a 4 or 4.5% cost of funds, if you discount the arrival of free cash flow from the deposit for 5 years as opposed to for 15 years, you have a much higher net present value around a deposit that's going to be put into production this cycle rather than next cycle. I realize that investors want easy rules of thumb to apply. The problem is that the easy rules of thumb are normally valueless.
I agree with that, especially about us investors wanting easy rules of thumb to apply. And this is what I suspect. You tell me where I'm wrong, but I suspect that these few steps that you just mentioned, 3 or 4 steps or so, those might be causing lower valuations on the pre-development companies. Because when I do look at the development companies, we've seen a couple of feasibility studies come out recently, a couple of renewed feasibility studies between now and the last time you and I spoke. And I was not as happy with all them because I thought that most of the companies publishing them are already trading at or near 1 time net present value, which makes me think that, okay, this is a clear calculation that is just presented to investors. They can see it, they see there's value, so everybody's jumping on that. So where is my edge in this situation? Whereas with the explorers, I can do this back of the envelope calculation and already have an edge. Am I thinking reasonably?
That's absolutely reasonably, but you can still have an edge with the developers in the sense that many people read the pre-feasibility study or the preliminary economic assessment or the bankable feasibility study, but they don't read the whole thing. They just read the headline. So if you look at NextGen as an example, which has a very rich valuation, but has an extremely rich deposit, what the feasibility study doesn't take into account is the probability of exploration upside and the possibility that that deposit gets built in conjunction with Fission's deposit, which has the impact of cutting $800 million out of the combined capital expense. People don't want to have to think that much. People want to listen to an interview like this and get really excited and buy a stock and have it go up by 350%, preferably by Christmas.
Hey, I want to do that.
But that's not the way the investment process works. You have an edge by thinking more, knowing more, and working harder than your competitors do. So even in the development stage companies, if you think through the feasibility study, if you read the feasibility study, if you take into account the questions that are legitimately asked by a feasibility study and the opportunities that are legitimately presented in the feasibility study, you can have an edge over other investors because most other investors, including institutional investors, don't do the work. They don't take the study in context.
But it sounds like hard work. Like I would want to do that. I have absolutely no problem putting, 10, 20 hours, whatever, reading through a feasibility study. But I'm not sure I have the mental capacity to get a decent conclusion on it. So doesn't that take more experience?
Antonio, you don't have to get it right. You just have to get it more right than your competitors. And interestingly, I don't know what the universe of uranium speculators in the world is. Maybe 50,000, maybe 60,000. I would suggest that maybe 500 of them do the work. Mercifully for you, and this is a dated phrase, your Rolodex, your contact file, it includes some people by now, our mutual friend Justin, among others, who will do some of the work for you. Many of us are predisposed to answer questions that we think a lot of people want to hear the answer to. So you have to ask the question correctly. You have to say, where do you think the misidentified opportunities around this feasibility study exist?
Yeah.
I hope that helps. You are correct in saying that the earlier stage companies have had fewer unanswered questions answered. So less is known about the deposit. Because they're small capitalization stocks, you have less competition in terms of knowledge acquisition, and you have a greater opportunity to be right relative to your competitors. The offset to that is the fact that it's a higher risk activity generally, and you have a greater opportunity in that to be wrong, not relative to your competitors, but rather absolutely wrong, relative to companies that have less upside but have more broad distribution of good knowledge.
Yeah, because the downside is not really limited, and I guess on a feasibility, especially if it's a definitive feasibility study company, there's the downside is rather limited to some type of an NPV.
I mean, the best opportunity occurs in high quality companies in market panics. If we were to have, and we could, I'm not saying we will, in 2023, it would be easy for us to have a circumstance where there was a liquidity squeeze, a la 2008, and where the broad equity market sold off by 40%, and the speculative equity markets fell off by 60 or 65%. In circumstances like that, you are able to buy very, very, very high quality information at panic prices. It's just that you have to have the courage to do it, and you have to have enough liquidity yourself so that you can take advantage of the circumstance as opposed to being taken advantage of by the circumstance.
Last time we spoke, you told me that there is something like good enough of a price and that you shouldn't necessarily wait for the bottom. Are you waiting for something like that to happen? Or, I mean, I guess you are with a portion of your capital, but how big of a portion is that?
I've got about 60 companies on my shopping list now. And they fit broadly into beta, value, or speculation. And I try to keep the portfolio relatively balanced according to my own criterion. Understand that I'm old and fat and rich, so that my segregation will be different than your segregation. But then I employ what I consider to be a relatively attractive scale, which is to say that if the gold equities fall off substantially in price, I focus my buying on the gold equities. If, by contrast, let's say that we had a nuclear accident somewhere, I would begin to focus on the uranium equities. If we have a circumstance where my president, the Canadian Prime Minister, sound off on an anti-oil, anti-gas theme, then I try to take advantage of the stupidity engendered by their remarks. I also believe now, and we've discussed this a lot, that despite the fact that holding cash imposes real penalties, which is to say the interest that you receive is less than the depreciation of the purchasing power of your savings, that you have to remain highly liquid, because I think that there's a strong possibility, if not a probability, that at some point in time we have a global recession. And I think that there's a possibility of a liquidity squeeze. I'm not holding off purchases in anticipation of a 50% off sale, but I am keeping ample financial resources so that if one occurred, I would have both the psychological and the financial tools to take advantage of it.
See, I'm not a native English speaker, so I don't know what ample means. What is that in numbers? I know numbers.
Ample varies. For me, I have over ample right now, which is to say that I sold some very, very, very long held assets. And as a consequence, I have too much cash in my portfolio. But I suggest that most investors need a liquidity cushion. A liquidity cushion, by the way, above their lifestyle needs. I believe that everybody of every age needs at least 3 months living expenses in cash, which you don't even touch for investment. You use it if something goes wrong. But I also suggest that most investors, depending on how speculatively inclined they are, need to have a liquidity cushion of between 10 and 20% of their portfolio. The more speculative the investor, the higher the liquidity cushion needs to be.
Yeah, I guess that makes sense. If we look at your rankings, though, in that period, a lot of risk has left the market, which has drawn uranium stocks, as we mentioned, down. Have you been able to rank any uranium companies as like in higher tiers, 1 or 2 or 3 or something along those lines?
I do have a 3. I have a higher number of 4s, but I'm in the process of reevaluating all that. You may know, Antonio, I'm in the process now in retirement of starting a new bank, my 7th. And the consequence of how hard I've been working on my banking and insurance business is that I haven't been as able to upgrade the rankings database as I would otherwise have done. So we're in the process now. When I say we, I don't do it by myself anymore. I do it in conjunction with a team that helps me. And my belief is that the entire rankings database will be updated again by sort of January 15th.
Okay. And then I'm assuming since the last time you updated it, uranium stocks have fallen because they haven't really done anything else but fall. So that means there's going to be more 3s on there?
I don't think so, because the overall population of uranium companies is so small. Understand, too, that the database reflects my own biases, which means that the highest ranked uranium stock in the world by my criterion is Kazatomprom. Many people wouldn't own Kazatomprom because it's less responsive to moves in uranium, ironically, because they're a low-cost producer, which is to say they don't have as much operating leverage, and also because the narrative involves Kazakhstan. I'm personally much more willing to take political risk than many people, and much less willing to take technical risk than other people, simply because 50 years in the investment business has taught me that while political risks are real, technical risks are more real. So the bias that comes from my experience is reflected in the rankings database.
So here's the thing about Kazatomprom. I interviewed one of their IR guys who is like, you can see the quality of the company by the quality of their IR. That's actually very funny, but I've only gone to 2 conferences. You go to the booth, you see the type of quality of IR people that they have. It's not guys, sometimes it's gals. And you can see a lot about the company. Their IR guy was many times better than most CEOs that I've interviewed. And I like that a lot. And then, I've watched all the other interviews. I understand their assets, the development of their well fields is incredibly easy. The technical risk that you mentioned is therefore covered. And I understand all that. But I'm just wondering, with the political risk, is the market ever going to want to see the company for what it's actually worth, or is it always going to have a cloud above its head that is going to be that political risk and therefore never materialize in a profit for me?
The answer to that is that your upside is going to be more constrained and your downside is going to be less. You have a much, much, much higher quality asset. You have, as you pointed out, in middle management at least, superb range of talents, better than you see in other countries. Probably the best opportunity for advancement in the private sector in Kazakhstan is in Kazatomprom. So you don't have the diffusion of talent to places like technology or finance. You have an absolutely superb range of human resources. You have great free cash flow. You have a development pipeline that is probably 75% of the world's development pipeline, all controlled in one company. So while you will likely not experience the narrative-related upside in Kazatomprom that you would in Cameco, you also have the sheltering impact of value and quality that's absent in other companies. I'm not trying to say that Cameco doesn't have high quality assets. I'm just trying to say that comparing them on a valuation basis by any metric other than narrative brings you to Kazatomprom. And by the way, I'm a big Cameco shareholder.
Sure, I want to circle back to Cameco here in a second, and also what that's exactly what I'm thinking there is because there is more value, but I would like I don't really profit of the value as a speculator, profit of the share price movements.
You
And
do.
so maybe
You
it
do.
depends.
It limits your risk. That's how you profit from the value. Remember, there's two sides to the equation, upside and downside, and they're both considerations worth pursuing.
I see you smiling as if you know that I'm going to make a big mistake and I'm going to be sorry about it because you maybe made it yourself.
I'm not. I was a speculator when I was your age. This isn't about you this time, Antonio. This is about me. I look at the mistakes that I made up to age 30 by chasing unbridled upside and not paying attention to my downside.
That's me.
At age 30, I recognized my downside. And the consequence of that is that I went from being a very wealthy, hubris-ridden young man to being a somewhat more humble man with a negative net worth. I have no interest in repeating that cycle personally.
Would that mean that you don't necessarily want more exotic jurisdictions than Kazatomprom? Because that's than Kazakhstan, I mean, because that's still a thing. I mean, you got Brazil that I know that you're interested in.
Yep. I don't consider them to be exotic. I think that every political jurisdiction is lousy. I don't think there is a good jurisdiction. I think they're all terrible. I think that the basic reason for government to exist is to steal on behalf of various constituencies. So I think that political risk exists everywhere. The question is, how much do I charge for it? People like you and I, which is to say Caucasian people, often Caucasian English-speaking people, still set the norms in terms of investment narrative. And people that look like you and I tend to believe that familiar political risks should be discounted less than unfamiliar political risks. What I have learned in 50 years of investing is that money that's stolen from me by white people in English, according to the rule of law, is just as gone as money that's stolen from me at a spear point in Africa. And so I look at political risk as a function really of experience and the extent of loss. The best country in the world for me in terms of money in, money out, personally, was Congo. Did I take high risk? Absolutely. Did I understand all the risks I was taking? No. But there was no other country in the world where I could have participated in the proliferation of tier one deposits at stupidly cheap prices that I did in Congo. The second best jurisdiction for me was more politically palatable. That was Chile. Now, Chile has become more politically risky because the voters in Chile have begun to feel like they should kill the goose that lays the golden egg, which is to say that they should increase the social rents on extractive industries. Chile is being priced on a historical basis when it becomes somewhat less attractive on a looking forward basis. I would suggest to you that there are some jurisdictions in the world, the People's Republic of California or the People's Republic of British Columbia, that are extraordinarily more risky than investors believe. And I would certainly, in the context of a mining business, prefer to invest in a tier one deposit in Kazakhstan than a tier three deposit in British Columbia.
What about some of the, because I know you're interested into, I mean, you had a good experience in Africa with Paladin during the last cycle in uranium. Is there something like that in Africa that catches your eye? Because Paladin, what they did is they went from, if I'm recalling what I've read correctly, they went from a shell to making a discovery to going into production within one cycle, and that was the extraordinary thing. I don't know if Africa necessarily played a role, or if the deposit only. I mean, everything played a role, but like, is there something like that that you're noticing in Africa today?
Well, historical note. Remember, first of all, that Paladin didn't have to make a discovery. Nobody cared about uranium. Paladin owned the West German government's database, the Uranerz and Urangesellschaft databases. And John Borshoff didn't make a discovery. What he did was take $1 billion in exploration expenditure by the German government and stake 3 prior discoveries. These deposits had no net present value at $8, and they were enormously valuable at $30 a pound. And he didn't spend any money on exploration at all. He spent the money on staking them. As the uranium price rose and his cost of capital fell, which is to say his share price rose, he was able to beneficiate those projects. But the truth was they were already economic at $30 before he bought them. He bought them for nothing because the price was at 8. He did an absolutely masterful job of taking a database which nobody put any value on and making $5 billion out of it. Fast forward to today, 2 of the best uranium jurisdictions in the world, I believe, politically, Namibia and Botswana, are both in Africa. In terms of the government's understanding of the role that uranium might play in the development of the country, and 2, in terms of the social acceptance of the fact that foreign investors need to be compensated for the risk that they take. Namibia and Botswana are both very forward-thinking political jurisdictions. They are both undeveloped in terms of the legal precedent around the rule of law. So you need to deal with more unanswered questions in terms of how disputes will be adjudicated in those countries. But you have a circumstance where you have high prospectivity, you have decent infrastructure, and you have a very good political and economic jurisdiction. 2, the Lotus deposit in East Africa, I think, is a very well understood deposit, although the political risks associated with both Kenya and Tanzania are somewhat less easy to understand. And probably the best jurisdiction in Africa in terms of geological prospectivity, or at least what's known in terms of geological prospectivity, is Niger. The political and social outcomes in Niger, both in terms of the political class and the rule of law, but also in terms of Islamic terrorism in the country, present some social and political unknowns that begin to temper the prospectivity. But I, in my own life, have prospered by being willing to take high perceived political and social risks if they were accompanied by a tier 1 deposit. If Niger gives me in this cycle a discovery that has tonnage and grade that tells me that that deposit is in the best decile of deposits worldwide in terms of return on capital employed and also all-in sustaining costs, I will be willing to risk personally Al-Qaeda, ISIS, and an undeveloped body of law around the rights of foreign investors.
You said grade and tonnage, and you mentioned Namibia, and 2 of the companies that I'm thinking, one of them I recently interviewed, Bannerman, they are lacking grade, but they do have the leverage because they have a very high incentive price. Is that because I'm sort of getting...
I like Bannerman because I like the guy. I think he is one of the best thinkers and one of the best promoters. And as a consequence, he will have a lower cost of capital relative to his peers. I don't like the deposit because I think I get enough leverage in high quality deposits that I don't need unbridled leverage. And I see that deposit personally as a tier 2 or tier 3 deposit. I see it as one that has a high probability of getting built because I think that the human being behind it is as smart and as determined as John Borshoff was when I ran into him in Paladin 30 years ago. The natural resource there that really attracts me is the CEO. You need to understand, too, that the discussion that you and I are going to keep having is one around unbridled upside, which appeals to a young man, and the juxtaposition of upside and downside, which is something that's more current with an old man.
Hmm. Do you think that John Borshoff still has a tier 1 deposit today, even though in a different company?
I don't see it as a tier 1 deposit yet, but this guy has an uncanny sense, not just of commerce, which he obviously does, but also geology. He also has a skill set involved in attracting absolutely top tier earth scientists, not getting in their way, and empowering them. Borshoff is a unique human being. I'm delighted to have made his acquaintance, both for personal and financial reasons. Your risk with Borshoff, frankly, is he's older than I am. You actually have a mortality risk around Borshoff. He works 6 or 7 days a week, 14 hours a day, and he's in his 70s. If he has a question about something that might be happening in Namibia and Botswana, he goes there. Your real risk around Borshoff is, I think, mortality risk and the undue influence that he plays in the market capitalization of Deep Yellow. That said, I'm a large Deep Yellow shareholder.
Who do you think is the next Borshoff then? Do you think that's Monroe or is it somebody else?
I think it may be Monroe. My suspicion is that it ought to be somebody in the middle management at Kazatomprom. When I look at their bench strength, and by the way, when I look at the bench strength in China General Nuclear, some absolutely superb people there. There are challenges at the top. Understand that China General Nuclear is a creation of the Chinese state, which is to say, in one sense, it's a uranium company run by the post office. Yeah. But you have some absolutely superb people in that company.
Yeah, I mean, I have problems with communism coming from Eastern Europe and having heard all these stories that my parents went through and there's a show on Spotify that I listen to. It's called Real Dictators. Once you listen to the Lenin and the Stalin story, you don't really want to have anything. You just want to stay as far away from communism as possible. But
I understand that, which is why I left California. I understand it perfectly.
That's a good joke and a fair point, and it's a good joke because it is a fair point. What else I've been wondering? I'm gonna get a little bit selfish here because that's just how I am. But what else I've been wondering is that, and again, no place for me to hide this. My portfolio is down 40% because I was averaging up in a FOMO fashion. And I even had to take out some money recently for an unforeseen purchase. So that was an actual loss for me. And I was almost kind of happy to be selling because I got to sell the companies that I started disliking over the last maybe some 2 years or so that I, as the stocks were going up, I was like, oh, I know this company is going up and it's great. I know everything about it. I knew nothing about it. And so I was holding them, but I eventually got to sell it, kind of happy. And I'm still holding a significant to me amount of money, but I'm not still content. I'm not as happy with the way my portfolio is structured. And so I ideally, I want to ask you, tell me what to do, but I'm going to try to be a little bit more sophisticated. And I want to ask you, what do you think my options are? Like, what do you do when you're in that position where you don't really like the companies that you're in, but they're down 50%?
Sell. Being down 50% is arithmetically superior to being down 100%.
Yeah.
For years, Antonio, I have ranked people's portfolios, as you know. And very often you see a whole laundry list of stocks that people own. And it's very clear that I, working full time, couldn't know that many stocks, and them working an hour a month for sure. So we'll start at the top of the list. Amalgamated Aardvark, 2 A's, right? You say to the person, why do you own this? And they say, well, I don't know. Well, if you don't know, why do you own it? Well, I can't sell it. Why can't you sell it? I paid $4 for it, and it's at 60 cents now. If I sell it, I'll lose $3.40. And then you see to say, no, you've already lost $3.40. The question is, what are you going to do with the 60 cents that remains? And if you don't understand why you own it and it's selling for 60 cents a share, that means you just bought it for 60 cents a share. If you're willing to own it for 60 cents a share, which is the same as buying it, why don't you go buy another 10,000 shares at 60 cents? Oh, well, I wouldn't do that. Why wouldn't you? You follow what I'm saying?
Don't focus on the loss, focus on what's left and what you can do with it.
Yeah, Buffett famously says, in terms of discipline, most investors would be well advised to regard their portfolio as a small hog farm. Your capital is the trough, and there are room at the trough for 10 pigs. To add a new pig, you have to slaughter an existing pig. And if you look at the amount of capital that you have as your trough and you divide it into 10 pods, before you add a new pod, you've got to kill an old pod. And that imposes a certain discipline. I don't feel that I need any longer to be that mechanistic, because I'm mechanistic in other parts of my portfolio. But I think for young speculators whose time is valuable, it can be used in other pursuits, and whose capital is scarce, that putting in place some mechanism where you ration the capital is useful. I think, too, that even if you have a company that you really like, if you have taxable capital gains and the stock is off by half, that you sell the stock, harvest the capital loss against your taxable capital gains elsewhere, wait 31 days and buy it back. I laughingly call that the penny stock dividend. The fact that there is the opportunity for sort of perverse cash yields by harvesting tax losses. I have found, too, that if I sell a stock that I owned, when I go to buy it back, I look at the stock with a very fresh perspective. You have a built-in bias owning a stock that you don't want to admit defeat. Once you've sold that stock, you are freed of that bias, and the repurchase decision takes place in a much more rational environment than would otherwise be the case if you owned it.
A smart man once told me that when the reason to own something goes away, you should go away too. That smart man was you, and that was a couple of months ago. And that's maybe true that if the reason goes away, but if that means that you forgot the reason for something to own it, that means there's no reason for you to own it.
Well, if you don't know the reason, even if the reason hasn't gone away, it's gone away for you.
Exactly.
Many times in my career, I have bought a stock, a speculative stock, in anticipation of the answering of some unanswered question. When the answer came back no, as opposed to yes, although the stock was down by 30% or 40%, I had to sell it. The reason to own the stock went away. There can be a circumstance where you have a surface anomaly, let's say a gold surface anomaly, and your target size based on the surface anomaly and the data that you have on surface is, say, 1 million or 1.5 million ounces of potential. What you need to know is if the mineralization extends to depth. You put 2 or 3 drill holes in it, you get back very spotty results, which is to say that the surface anomaly does not project to depth. Your 1.5 million ounce target becomes a 250,000 ounce target, which is to say, in almost every circumstance, you have to sell the stock. But most people won't do it. Most people substitute hope for arithmetic.
Well, I'm most people in most cases, and especially in this one. So there's a listen for me there. Definitely. You know, I started harassing you on uranium stocks off the bat because that's where I'm suffering the most. But other parts of the market are suffering too. And you famously told me, again, last time that we spoke, that you had been selling your oil stocks, for example. That must have been June or July. And at least you were taking profits on some of them. And oil hasn't stopped falling since. Like, it had that big bump, and you sort of timed it perfectly there. So great luck or good on you for doing this. But What's your out, maybe not only on oil, but let's maybe to take it more broadly. What's your outlook on the world? What is your crystal ball telling you for 2023? Where do we go?
My
What's interesting?
my crystal ball tells me that there is a probability rather than a possibility of a recession.
Hmm.
It tells me that there's a possibility of some form of liquidity crisis, maybe not as bad as 2008, but maybe as bad as 2008,
Hmm.
which tells me that stocks that aren't high conviction stocks should be sold, and that I should build my cash balances. The other side of the equation is that society is underinvested in natural resources for 30 years, and we will hit supply cliffs, which means that the stocks absent the recession are attractively priced, and many of them will survive the recession. So what that tells me exactly is when I look at a stock like Exxon as an example, I believe that Exxon is worth twice what it's selling for.
Hmm.
I believe also that it could fall by half. And I'm willing to accept that because I am likely to continue to own Exxon for as long as I believe that it's a high quality, functional business selling at a discount.
Hmm.
Uh, there is an amount of money that I am willing to invest in Exxon, understanding that it could fall by 20% or 30% or even 50%.
Hmm.
But where I believe on a net present value basis that it will generate 15 to 20% compound internal rates of return to me over a decade. So I'm willing to accept a temporary possible decline against a probable return on capital employed, which I see at an enterprise value basis of being very, very low risk.
Hmm.
At the other end of the risk spectrum, the end of the risk spectrum that drives the imagination of someone your age, when I look at a couple of the smaller tertiary Lundin exploration companies, in particular Africa Oil, and I see companies that are selling at a greater than 50% discount, and I see baked in value drivers, which is to say, I see a company that I'm not saying will, but could give me 1,000% returns in 5 years, but could also cost me half my money. The juxtaposition of the possibility of a 10-to-1 return against the possibility of a 50% loss is a juxtaposition of value that I'm all over.
Hmm.
I love that. So you asked me for my outlook on the world. It's clouded. The material stuff of humankind, which is to say natural resources, are both cheap and scarce. And we've underinvested in them for a very long time, which means, particularly given the woke politics of today, where you're supposed to solve all the problems of humankind by an algorithm rather than by material progress, that material assets, high quality material assets, will continue to increase in value. But we are going as equity investors to face periods of increasing volatility and increasing risks. Those are very different propositions, although for most people they're the same. All I'm suggesting, I think, is that you go into it with your eyes open. You take into account the risks and how you will likely respond to those risks, and also the rewards, and how much your desire for the reward overcomes your fear of the risk.
Hmm. What I'm hearing, if I had to translate it to my sort of primal brain, is that buy high quality copper companies, for example, because copper is something that we're going to need. High quality natural resource companies of that sort. But I'm also thinking about gold and silver, which I know that they have a special place in your heart. But can a successful speculator even afford to have a heart? I know about that, and I don't know if we actually do need gold and silver. So where do you stand on those two?
I need gold and silver for my own psychological well-being. Gold has functioned for a millennium as a form of an insurance policy. Interestingly, because I buy it as an insurance asset, I sort of hope it doesn't go up in price. I'm struck at conferences by people saying with some glee that gold could go to $10,000. The circumstance that would see that occur would be very difficult on your lifestyle. And my lifestyle is damn good. So I don't want to see it altered. But when I look at the contingencies that people have traditionally insured against with gold, I see the probability that an investment in gold is intelligent. Gold traditionally has done well when people lose faith in savings instruments denominated in fiat currencies. Well, that makes a great case for gold right now. The strongest currency in the world, the most liquid, and frankly, the most transparent is the US dollar. And if you look at the value proposition offered up by savings in US dollars, you're attracted to gold. Let's look at the US 10-year Treasury, the deepest and most liquid savings market in the world. The US 10-year Treasury proposes to pay you 4%, and they will, because the US government can print the money or use battleships to steal it. So they will pay you the 4%, but they're paying you 4% in a currency where the purchasing power is declining by 8% compounded. Their number, not mine. So in the US 10-year Treasury, the US government absolutely positively guarantees that you will lose 4% of your purchasing power annually, compounded over 10 years. Gold has to compete with return-free risk. Now, can it compete with return-free risk over 2 weeks or 3 weeks or even over the election cycle? Maybe people are afraid of Trump for good reason from my point of view. So maybe they're heightened in the near term. The perception is heightened because they believe that Biden, who also terrifies me, will be returned to office. But that's all narrative. The arithmetic is that you lose 4% of your purchasing power compounded every year for 10 years. Truly return-free risk. Gold competes with return-free risk. I hope gold loses, but I don't think it will.
Okay. So green light for the pet rock. That's what I'm going to write down. But it's for insurance, not for speculation. Is that right?
For me. Yeah,
Okay.
for me. To speculate in metals, I speculate on silver.
There's better metals to speculate on, yeah.
I don't know why silver outperforms gold in the last half of a bull market. I'm not smart enough to know that. But I am smart enough, having watched bull markets for 50 years, to know that historically it's been true. So I invest in gold and I speculate in silver. Similarly, I allocate lower risk capital to the high quality gold stocks, and I allocate my mad money to the silver equities. Doug Casey pointed out to me years ago that the market capitalization of silver equities is so small that when the generalist money comes into it, the effect is like trying to siphon Hoover Dam through a garden hose. There isn't sufficient market capitalization to hold the money that comes into it. And those are extremely pleasant times when they come. They may only come 2 years out of 10. But being in place to enjoy it, I'd like to do it one more time in my life.
I like the garden hose analogy because it's about silver. But if you start talking about the uranium equities, then the garden hose turns into a paper straw.
Correct.
So that's an interesting
and frankly, that's a higher probability outcome, I think, than silver. Remember that we do a strange thing with precious metals. We take them out of a hole in the ground called a mine, and we put them in a hole in the ground called a vault. Mostly they don't go away. When you look at supply and demand, silver does get used in some purposes, but most of the precious metals that have ever been mined are still supply. You have 10,000-year-old supply. Uranium goes to uranium heaven.
Especially with some of your employers. So.
Yeah, we've broadened the definition of heaven, I guess. Yeah.
True. What about another asset then is very dear to most people, everybody? I want to say is housing, because rates and housing and how those two work together. There's speculations about we don't have enough inventory of housing, but then rates are going up. So some people's mortgages that they couldn't afford before that are going to make them realize that they couldn't afford before then, therefore thhere going to have to lose. So what do you stand on housing?
Well, that's a broad topic, and I need to say that I'm not. I have less competitive knowledge of real estate than I do other sectors. I will say that housing in particular has different attributes for different people. I'm going to get a lot of hate from female listeners for this, but for traditional women, a house isn't an investment, it's a home. It's a sense of security. It's an icon for her family. And people who are involved in traditional relationships, be they male or female, need to take into account the utility, the psychological utility of shelter. And there are some aspects of that are non-financial in nature, something that I ignored in my youth at my peril.
What does that mean? I want to know more about that.
It means that you don't always look simply at the dollars and cents around shelter. If you are looking at shelter as a portfolio class, which is to say, if you can afford a place to live, there are certain circumstances where, on an economic basis, you over allocate to shelter because of the intangible benefits to your family and to your spouse. That's all I'm saying. It's an investment that includes lifestyle, and it's important. Okay. Mostly for me, I looked at real estate in very conventional financial terms, which is to say that if the rent associated with a piece of property could be expected to increase by 4 or 5 or 6% a year, while my cost of owning that capital, represented by a 30-year fixed mortgage, could be expected to stay the same, I looked at the delta between the cost of capital and the avoided return, or the rent, as I looked at the net present value of that expanding delta over 30 years, and that told me something about the net present value of the shelter. It is true that every year housing becomes more expensive because the replacement cost of housing is exacerbated by politics, which is to say everybody's a developer until they have a house. After that, they become an environmentalist. Nobody who has existing shelter wants increased density. Everybody wants affordability in somebody else's neighborhood. And that means that the supply of housing in markets that can afford housing will always be constrained by politics.
That's shelter and energy and other utilities that we've been talking about. And a not so much discussed topic is the topic of food, which has been heavily influenced by the war. It's not only food, it's might come off as a surprise to us in the West who turn on the faucet and water just comes out. But water is an increasingly hard issue. Is there some opportunity there that I could do something with my very little capital that might offer me an interesting return on capital, but it also might make me feel good because I'm doing something good?
Not that I'm aware of. I joke a lot. I've been a water investor for years in water rights, which is to say private water transactions. But my joke is that water is illiquid, which is to say if you were buying water rights, they've been bought. It's easy to sell water rights right now, but it's very, very, very difficult to buy them. And there are very few companies that are water as a resource plays per se. In the U.S. market, there are some fairly small, fairly closely held farming companies. Boswell, Limonera come to mind, where you own water rights as sort of a component of the cost of producing food. And in those cases, the water may be worth more than the real estate. But for most investors, those sort of deep value activities are too boring and perhaps too sensible to attract their attention. I have myself, as you may know, Antonio, moved to Washington State. And despite the fact that we have ample amounts of water falling out of the sky, I've decided that it's worth my while to spend capital to secure my supply. So although I have a very nice well, I have an 8-gallon-a-minute well, and I consume about 2 gallons a minute, and I have storage, which allows me to do that. because my well is only 300 meters from the sea, I am going to invest in another well further back. And at the same time, I've invested in a water capture system on my house and a 75,000 gallon reservoir. For most of the last 150 years, people in the West have come to believe that water is their right and that the government will guarantee their water. I believe that those people are in for a very rude shock. When governments look at water, they look at it as a source of votes. Water, in fact, flows uphill unnaturally to politics rather than downhill to utility or money. And one consequence of that is that in most of the West, the revenues that utilities, mostly government controlled, have enjoyed from water have flowed into the general part of the budget, which means that the politicians can spend those revenues on near-term vote-buying activities. And what that means is that for 100 years, we have underinvested in the maintenance of our water infrastructure. In New York City, I'm given to understand, and I don't know why it wouldn't be the same in Brussels, that fully half of the water that enters the system in the reservoirs is lost to leaks before it comes out the faucet. And that circumstance is getting worse, not better. So to the extent that your listeners have come to rely on the Commonwealth for their water, I would suspect that they would be well served to do some original research, and to the extent that they're able to, make arrangements to secure as much of their own supply as they could, be that through investments in conservation in terms of their use, or acquisition, or storage. I don't know the European circumstance, the European urban circumstance, as well as I know the American urban circumstance. And the American urban circumstance will deliver us a series of crises over the next decade.
Well, our water over here in urban area in Belgium smells and tastes like algae in the summer because something in the wells that I don't quite understand, but it's horrible. So that might be a good point there. I think that some people are doing something about it, but definitely not a lot of them. Is there something else that you think is a big topic, but we're not targeting or is not being targeted enough next to these things? Because we talked food, shelter, energy, some of the special metals, something else.
That probably has it. I suspect that what we ought to do in future interviews is take one of those topics and do a deeper dive. What that will do is disenfranchise about 75% of your audience. And it will earn you the undying love of the other 25%. What we've done today is sort of a survey. And the survey could be best said as employ common sense in sectors where there will be supply-demand imbalances. That's really what we've said. You may know, Antonio, or you may not, that at Rural Investment Media, I'm doing a video series called the Rick Rule Resource Classroom. And we try every week or so, whenever Albert and I actually have the time, to take one of these topics and go deeper in it. And I would be delighted if you wanted to pick topics that you thought were of interest to your platform viewers and go deeper into them.
That would be that. I would absolutely love that. I watch all these. I think you're at lesson 7 right now with Albert. I even commented on Albert's video and audio quality, which are great. I know it doesn't have anything to do with anything, but it was nice, and I thought, let's say it out loud. And I commented on that, so I have been watching those. That's Rural Investment Media on YouTube for people who are not aware. There's, again, 7 lessons. I think they're about an hour long, and they're definitely worth it. So I don't have any further questions, but I am looking forward to our next discussion to go deeper in some of these topics. And I want to thank you a lot for putting that much time in me today.
Well, a pleasure. And I would like to reiterate my offer to your listeners. If you care about my thoughts around the part of natural resources that matters to you, which is to say your own portfolio, If you go to ruralinvestmentmedia.com and list your natural resource stocks, I'll personally rank them, 1 to 10, 1 being best, 10 being worst. If I think my comments on any individual company have value, I'll make them. I'll comment on those companies. In addition, if you're an accredited investor, I will put you on my private placement list, which is to say I'll give you notification when I'm doing a private placement and why, for free. Please be patient. I don't do them frequently. I'm very picky, but it will be there. Just go to the question and comment section and write placements. Finally, I'm celebrating retirement by being part of my 7th bank startup. If any of your listeners don't believe that they're being treated well by their existing bank, if they believe, as an example, that they ought to be paid a fair interest rate on their deposit, or that they ought to be able to borrow against good collateral like gold, go to the question and comment section at Rural Investment Media and say bank. No, you don't have to be an American to enjoy our bank. Mm-hmm. So rankings, placements, bank at Rural Investment Media. And 2, enjoy the Resource Investing Classroom series. It will ultimately be, we think, a 32-part compendium of hour-long deep dive discussions into various aspects, of natural resource investing.
Well, thank you for that offer. You noted that you were picky, unlike my wife. So that is, I think that's a good virtue to have in the natural resource space. Thanks a lot for doing this, Rick.
Always a pleasure, Antonio. Thank you for making me laugh.